Anyway. All right, now I'm recording. Great. I am in Thailand right now, Hannah. I just flew in from Chiang Mai on Tuesday, Tuesday the 13th. So if you remember, those of you that are my students, if you remember, I posted that Tuesday was a travel day. That is why. So I was flying in from Chiang Mai to Bangkok. So I am in Bangkok for a month. So that's where I am now. Hey, James. Adelaide? Oh, your mother's from Laos. That's close by. All right. That is a good question. Laos is on the list. This particular tour, um, I've booked, uh, let's see, well, Philippines first, but then Thailand, then Vietnam. I'll be in Vietnam next month, and then for 6 weeks, I think, and then I'll be in Cambodia. So Laos is on the list, just not on this particular trip, because since I'm doing slow traveling, I want to kind of live like a local. What's weather like there? Fantastic question. So the weather's, man, I've been blessed with actually really fantastic weather over the past month in Chiang Mai. It was like it felt like maybe in the low 70s in the evenings, and then during the day probably in the upper 70s, maybe in the 80s on hot days. But for the most part, it's been really moderate. I mean, beautiful, beautiful weather. It may have even rained once when I was sleeping in Chiang Mai, but here in Bangkok, it's been great. I expected it to be a lot warmer, but weather's been really nice this time of year. Been lucky. So I'm here before the burning season, actually. All right, good. I'm glad I'm recording, and I always like to respect everyone's time. As those of you that have been in the investment or Moneymakers Club before, I'm always great on time. So according to my watch, it is exactly 12 noon on the dot. Jacksonville time. So it is exactly midnight here in Bangkok, Thailand. So for those of you that have been in the Money Makers Club, you guys know that I have been planning to still work and travel, and so I've been doing it since July of last year. I'm going to go ahead and share my screen so that way you guys can see the agenda. For those of you who are joining the Moneymakers Club for the first time, welcome. Moneymakers is basically, let me turn my chat box on. That way I can see the chat too, just in case folks' microphones don't work. There we go. I love seeing what the chat is going on as well. All right. So Moneymakers Club is a student-driven club, meaning that all of the topics are suggested by student members or even alumni of the club. And I am the faculty sponsor still. I decided to go with the heavy metal rock and roll hair as you see here. So those of you that have been in my live class before, I love to use filters, and of course, potato is one of my favorites. So student-driven club, all of the topics. Oh, thanks, Bridget. All of the topics are suggested by the students. Sometimes I may add an additional topic that I feel is timely and relevant to the market, but it is a totally free club. It is for fellowship and education, totally student driven. And since I'm the faculty sponsor and a finance teacher here at the college, I come up with all the educational handouts for everyone. So it's all legit. So if you want a copy of the educational handouts, I usually automatically email it right after the meeting to the members on the email list, so including the agenda. So which I'm going to go ahead and bring up on the screen today since I'm sharing my screen. So today we're actually going to do one of the member suggested topics from one of the previous meetings. I apologize, I did not have a meeting in December because I was kind of on the go traveling in from the U.S. to different countries. So I'm going to go ahead and start 2026 right off with a really cool topic suggested by one of the members today. And if I could swing it, which I may be able to, I might be able to double up on meetings this month to make up for the lack of meetings during the Christmas holiday season, which is great because gives you a chance to spend the holidays with your friends and family, not having to come into a Moneymakers Club over the holidays. So again, welcome those of you that have not been to a Moneymakers Club before. We are an officially chartered club at FSCJ since 2019, and we had met weekly when the club started in 2019. Then, of course, COVID hit, and we switched to online. And once campuses opened up, we decided to have meetings once a month at a couple of different campuses, like Kent and Deerwood and Southside. So right now, instead of the live meetings face to face, which we did have in November, because I was back in the States briefly in November between tours. And so going forward, at least till April, we're going to have our virtual meetings. And knock on wood on my table, the streaming signal is going to be strong, and it looks like it is. Looks like we're having no problem streaming here. I've always heard that internet is strong in Asia, and so hopefully they're going to prove me right. So let's jump right in. What's going on with the market? You know, those of you that know me know that I am one of those nerds that watch the stock market ticker symbol every day, look at the futures markets in the middle of the night, which oddly enough for me is in the middle of the day. And markets open now. So it actually works out pretty well because here, US markets won't open till 9:30 p.m. So I can spend my day and then not have to trade until the market opens. So I already did a bit of trading, more like some buying. Only had just a couple trades today, but more buying of some ETFs before the meeting and based on some capital that was freed up from trades yesterday. So one of the primary things going on with the market these days is geopolitics. If you notice that, um, and again, I look at the news a little differently than most. Those of you that have taken my class before, I always look at the news in terms of how does it affect the ways that I can make money. So with geopolitics in particular, of course, we have the conflict in Iran or the uprisings in Iran that could affect oil prices, which could affect various costs of living because a rise in oil prices raises the rise in transportation costs. And of course, you know, businesses are not going to eat that. They're going to pass on those cost increases to the consumers, which means we may pay higher prices. But right now, uh, oil prices have not really been affected as much. There was a little jump since Iran has one of the largest proven reserves of oil in the entire world, but there was some calmness after I guess the United States basically wasn't going to be aggressive in their attacks to support the uprising citizens in Iran, although that still could be on the table. So you never know with this administration. But oil prices actually have been pretty stable. What has gone up due to geopolitics, both in Iran and other parts of the Middle East, because you know that there was bombings in Syria recently, and of course, you know the ongoing conflict with uh, or at the Gaza Strip, and that could affect oil prices. Another thing that it affects is commodity prices. A lot of folks, as a flight to safety, have been investing in commodities like gold and silver in particular. Gold and silver has had an amazing run, which is not actually the norm. And usually it's a hedge or risk against inflation, but recently it's more a hedge against risk of uncertainty in the markets due to things going on like geopolitical turmoil. And of course, the Ukraine war has been going on for multiple years now. Interest rates. One thing with interest rates, and that affects all of our wallets, if you think about it, from loans to home loans to credit card loans to the rates that you get at the bank. And because we've had such high inflation over the last few years, interest rates have been up. And the Fed Reserve raised interest rates several times since 2020 COVID to be able to combat inflation. So they lowered it when the economy weakened during that super quick recession in 2020 and 2021. But then with all those stimulus checks and of course the rising of prices, inflation just got out of hand. I mean, inflation that a lot of you had never experienced before for generations. So you saw everything you paid for go up: clothes, food, cars, homes. So to combat that, interest rates went up to try to suck those excess dollars out of the economy. With those high interest rates, of course, it makes it more expensive for businesses to raise capital, to hire people, to expand their businesses, things like that. So over the past year, interest rates have been dropping pretty slowly. There was another decrease in interest rates recently when the Federal Reserve met. But the big question is, can the Federal Reserve afford to continue to lower interest rates to help the economy, especially with businesses not hiring as many people? You know, is our economy weakening? So that's the debate. If economy is weakening, generally the rule in the playbook: drop interest rates, make it a little better for businesses to hire more people or to expand their businesses, jumpstart the economy again. But if prices are too high, then the playbook of the Fed is to increase interest rates. So you got two opposing things here, which is more of a problem: a weakening economy, low employment, or is it the fact that everybody's got to pay more for stuff? So do we lower interest rates and increase inflation again, or do we keep interest rates high to try to get inflation back down? Inflation historically is still above what the Federal Reserve wants to see it at. So the Federal Reserve only has really two mandates as their job. It's stable employment and stable prices. And so, and I don't envy their job. And the chairman of the Federal Reserve right now is he's kind of been on the hot seat. He doesn't have Donald Trump as a fan right now, but it's an independent agency and he's supposed to do what he wants without political influence. So unfortunately, or fortunately, depending on how you look at it, his job term expires in May. So the federal president's going to have to appoint a new Federal Reserve chair. And so the question is, that's on a lot of people's minds, including investors, is he going to appoint someone who will be independent in his job, or a puppet that could be easily influenced by the president, meaning it's likely interest rates like to go down. So stock markets like lower interest rates, because when businesses have to pay less for credit and borrowing, that means profits go up. When profits go up, stock prices go up. So that's the kind of like the environment that we're in right now. And then earnings season. Earnings season every quarter. Every quarter, companies have to report how they did this past quarter. How much revenue did they make? How much profits did they make? And to kick off earnings season last week, they start with the banks. So multiple of the big boys, Goldman Sachs, Morgan Stanley, JP Morgan, and I have been happily trading those because the financial sector has been a really strong sector recently. And those have been really good trades for me, the financial stock. The big ones in particular, JP Morgan, Morgan Stanley, Goldman Sachs in particular. I like those trades. So I waited until they announced their earnings last week and then went back in when the prices of those stocks dropped. And they do. I mean, sometimes stocks go up after they announce earnings. Sometimes they go down after they announce earnings. When I discussed this in Fin 3400, and in the investments class, especially in the investments class, because we talk about psychology, which we don't in other finance classes. What's interesting is that um, the human nature or psychology involved with how it affects stock prices, because you can have JP Morgan, which announced fantastic earnings, profits, and higher level of revenue than they did a year ago, and the stock went down about 6%. So go figure. And then you got a company that um, maybe didn't reach their profit targets, and then their stock could go up after that because they saw something different that they like. So it's fascinating just to see the dichotomy between earnings reports and how the stock behaves afterwards. So think of earnings season as another catalyst that you can use to jump in on stocks that you like when they're cheap, or to add positions when you think that you're buying into strength. So quarterly earnings is definitely a good catalyst for getting in if you are a shorter term investor or a trader. And finally, what's going on in the market? Chips. So we know one of the biggest things in the news these days beyond business is artificial intelligence. And AI can't power themselves without the fastest computer chips that they can make on the planet. And there are only a handful of companies that produce those processors, like AMD, NVIDIA, Intel, for example. But where do they get those parts? And this is where you can kind of go beyond the big names at the top level that we all know of, like NVIDIA, and then go towards the manufacturers of the components, like Micron Technology or Taiwan Semiconductor, which just came out with earnings yesterday, as a matter of fact, and they had blowout earnings. And to illustrate what I mean, let me pull that up here, so that way you can take a look at what I'm talking about. So here's Taiwan Semiconductor. Of course, there's a little backdrop concern with Taiwan Semiconductor. There's always that little shadow in the background that is China going to invade Taiwan? And there's a lot of military exercise and everything like that. Well, Taiwan Semiconductor, here we go. One of the top makers, if not the top maker, of the chips that NVIDIA buys to make their artificial intelligence processors. So if you take a look at just the last 5 days, of course, if you were prescient enough to get in on right before earnings, and that's the risk. There's a 50-50 shot with earnings. It's a great catalyst. You can go in right before earnings, and if earnings are great, and then you could see your stock shoot up. Of course, you could see your stock drop down as well. Those of you that went into Taiwan Semiconductor, I actually closed my position in Taiwan Semiconductor. I waited for earnings and then got back in yesterday. So here's the 14th, 2 days ago, and then here's the 15th, where it went up from. Oh, hey Niv, come on in. We're just going over the first item on the agenda on what the market's doing right now. So here is Taiwan Semiconductor, $327 on the 14th, and then we get to the 15th when the market opens, and it shoots up all the way up to, yeah, $343, so $20 a share in one day. Then we get to today, just after the market opened, it was already up to 346, so it's creeped up a little bit more, but huge jump after earnings. We go back to one of the finance stocks I mentioned a little earlier, JP Morgan. Great revenue. I think they had about 40% increase in their revenues from commissions from trading. Oh, good. JP Morgan's had a nice recovery. So after earnings on I think the 14th, let me show you. Yeah, so it was a big drop. Actually, it was the 13th or 14th. Yeah. So it was a big drop here. Got out of my position, but a good day today. I figured JP Morgan would recover. So look for those opportunities, especially if you have a catalyst like an earnings date. If you think the stock is going to drop due to earnings, then you can get in, um, wait till the drop and then get in. If you think the stock is going to shoot up after earnings, then you can get in right before earnings and then anticipate that increase. So again, there's a lot of technical tools you can use to take a look. Of course, when you're talking about actual financial numbers, that's fundamental analysis or fundamental trading. So two different schools of thought when you're looking at to play the swing in stock prices. But as an options trader, I usually take a look more for longer term contracts. So I'm not looking for the day to day, but I'm looking at days every day to see when I should initiate my options trade. So going back to the agenda, yeah, computer chips, definitely a sector to keep an eye out on. And of course, I tossed in financials for extra measure. What has been driving the stock market? If you take a look at statistically, even the S&P 500, what has been actually moving the market most? It's really just about a half dozen stocks, and mostly the Magnificent Seven, which is what they call or nickname them. You got your NVIDIA, Microsoft, Amazon, Apple, Alphabet, Meta. So all the big boys basically move the market. So if you actually look, even though the markets ended up about 18% last year, if you look at how many stocks in the S&P 500 actually went up, you'd actually find, amazingly enough, that the majority of them actually went down for the year. It's just the big few that actually drug the market kicking, screaming to an 18% gain. So if you got an S&P 500 index fund in your retirement account, you're totally happy. That's a great year. So you have no complaints. I think what the market's trying to do right now is they want to give the other 493 stocks a chance to catch up. And that's why you see a lot more activity and growth in uh, stocks and ETFs that represent other sectors of the economy besides technology. And that's actually pretty healthy. The tech stocks are down, but after earnings, they'll probably do their thing and hopefully drive the stock market up. But hopefully everybody else will go up along with it. So that is the ideal. Is that what's going to happen? Who knows? So that's why I always look at it every day. Markets closed on Monday because they're not open for the holidays, so we get a long weekend. So one of the topics that was suggested by one of our members was, could we talk about what the difference is between index funds versus ETFs? Like, yeah, that is actually a good basic topic that maybe all of you have heard of these index funds. You probably may even own them, or maybe not even realize you have them in your retirement accounts, versus ETFs, which basically do the same thing, but there are distinguishable differences between the two, and I'm going to talk about that. I actually typed up a information handout or educational handout for you guys, which I'll email the membership after this meeting. So here it is, and I tried to keep it pretty basic and easy to understand. So ETFs versus index funds, both are great. They both got pros and cons. If I had a choice. I like ETFs for ease and also for tax efficiency, and we'll just ease in buying and selling shares. But I actually have both. I don't have to babysit my mutual funds, or AKA index funds, and I may look at it maybe just a few times a year because I'm not actively having to manage those. So versus ETFs, I bought a whole slew of, I think in specifically, I think I counted like 36 different ETFs I bought today before our meetings. So I have a whole formula of percentage allocation that I use to buy specific ETFs. So whichever one you pick, start early. So those of you that are in my personal finance class, I can't emphasize enough, the old Chinese proverb, the best time to plant a tree was 20 years ago. But the second best time to plant a tree is today. So that means if you haven't started investing yet, start now, because one of the things that you can ask any retiree or senior citizen is that they always wish that they would have started early, because the later you start, the more painful it is to play catch up. Even waiting 1 year can cost you tens of thousands of dollars. I like to use a chart. Sometimes I'll show in my personal finance class a 21-year-old versus a 20-year-old, or a 31-year-old versus a 30-year-old. How much more it costs per month, it costs you per month by just waiting a year to start. So don't. If you have, fantastic, keep it going. So index funds and ETFs, they're two of the simplest, and they're both low-cost ways to start investing if you haven't already. So these are two great ways to do it. If you're not comfortable with researching individual stocks, don't worry. These are two options to begin with until you begin your comfort level with investing in stocks. They're beginner friendly. They offer diversification, meaning that both of these types or forms of investing offer you the opportunity to not put your eggs in one basket. There's 11 different sectors of the economy, and you can spread your wealth amongst all 11 of them. So if you're a long-term thinker and investor, which you should be, then these are the way to go. You can't go wrong with either one. But I want to explain to you the differences between each of these, since you probably heard these from the talking heads on TV, especially those that want to sell you investing advice. So what's an index? First of all, why is it called an index fund? So a market index, it tracks a group of assets. So the most popular ones, and there are, believe me, hundreds more different kinds. Uh, the S&P 500 is the most well-known and is Warren Buffett's favorite. It's the 500 biggest U.S. companies. So the 500 biggest companies in terms of market capitalization, meaning that what they're valued. It's just their share price times how many shares are out there. So the higher the share times the number of shares, the more valuable it is. And for the longest time, Apple was the most valuable company in the world. It was overtaken by Nvidia just last year. So there's only 5 companies that are worth $1 trillion or more. And so by buying shares in an index fund, you get to have your money invested in the 500 biggest companies. Can't go wrong with that. And the reason why this is not a bad choice is because none of these companies are probably going out of business anytime soon. And the reason why they are the 500 biggest is that they all sell products and services that people are probably going to buy regardless of what the economy is going to be doing. Maybe more often than certain types of economies, but overall, they're going to be selling. And then we have the NASDAQ 100. Usually this is the tech stock. These include companies that are non-financial companies. So they're not all tech stocks, but you can buy an index of the biggest tech-heavy large companies. The Russell 2000, they're smaller companies, but the advantage with the Russell 2000 is these are the companies that probably have a higher potential growth rate. They may not be proven, but they may sell products and services that are part of the new economy. They could be quantum computing. They could be artificial intelligence. So they could be a brand new pharmaceutical company. They may deal in weight loss or new cures for cancer or new ways to develop agriculture or generate energy like SMRs or compact nuclear reactors. And yes, that's a real thing. That's a big thing, especially for artificial intelligence, because they need that efficient, cheap power. So there's 11 sectors of the economy. Great trivia question. If you can name all 11 sectors of the economy, is communications, tech, real estate, industrials, materials, consumer products, consumer staples. There's energy, there's industrials. Uh, so there are indexes for each of those. So if you want to buy a basket, if you want to buy without having to buy all of those companies, you can buy just a basket and invest in an index of just tech stocks or an index of just real estate companies if you like them. So there's international funds out there too. You could buy a fund that reflects just Chinese companies. If you think China is going to grow faster than the United States, invest in a fund in China. One that I've traded lately, actually, off and on in recent weeks, is a fund, an index fund on South Korea, because South Korea's economy is growing very well. And so, you know, a lot of stuff that South Korea makes, a lot of countries buy, including the United States. There's commodities, ETFs in gold and silver. I've been kind of a fan of recently. So ETFs and index funds, they're designed to match the performance of the companies that are indexed in that index. They're not designed to beat it. They're just designed to do just as well. So when you buy shares in a mutual fund of the S&P 500, when the stock market, this is basically when people say the stock market, they mean this. So when the stock market goes up, then years will go, your investment should go up by about the same amount. So stock market for 2025 was end of the year up 18%. Solid year. That means if you invested in a mutual fund in that, which 90% of my retirement account, you know, that gets taken out of my paycheck is in this. And then I got 10% in an international mutual fund, just because, you know, half the stocks that exist in the world are not in the United States. So there's other countries out there that make products that people like. I mean, you've heard of IKEA, you've heard of Toyota, you've heard of Sony. So it's nice to have at least a little exposure to international growth, because international sometimes may outpace the United States. Although the United States has pretty much been growing faster than most countries out there, at least in recent years. So index fund, they replicate a specific index. So how does it work? So you have money, you go to ideally a low cost provider or financial institution that sells mutual funds. Particularly Vanguard and Fidelity are two of the biggest, and they always have the lowest cost, meaning that generally it's low cost or almost pretty much zero cost to invest in their funds, and they will buy shares to replicate that whole index. So when you're buying shares of an S&P 500 index fund in Vanguard, Vanguard is going to put a fund together and pool all the thousands of investors that put money into Vanguard and say, all right, we're going to go ahead and buy shares of each of the 500 biggest companies for you. And then you're going to have a share of that. So it's passive. If you are intimidated, or if you work in a regular job and you don't have time to babysit a stock portfolio, no problem. Just stick it in the S&P 500. You don't have to pick the stocks yourself. I don't babysit my index fund like my active trades. I may have looked at my S&P 500 index fund in my FSCJ employee retirement account maybe about 5 or 6 times this year at the most. So I'm looking at it a little bit more because I'm thinking about maybe spending that money at some point. Another characteristic of a mutual fund or index fund, basically it's the same. They trade once per day. So whoever manages the fund, and with these index funds, it's done by computer. It doesn't even need a human manager that you have to pay for. The computer is programmed just to buy those shares and close those shares ownership once per day. If the company or Standard & Poor's decide to change the makeup of the S&P 500, which they do every couple of years, Matter of fact, one of the newest members of the S&P 500 is Robinhood. That stock became successful enough that Standard & Poor's, which created the S&P 500, decided to take a company out that is kind of older, maybe not as big or successful, and replace it with Robinhood because it's newer and bigger and successful and more reflective of what the economy, people in the economy does. So it replicates that list. The price per share of those mutual fund shares is called the net asset value, or the NAV. Ding, ding, ding. Those of you that are taking principles of finance, you're going as well as investing, welcome. This is a concept you guys are already learning about, or will learn about since we're in week one in the class. So net asset value, and all it is just what the company or the mutual fund owns, and then what it owes. So the difference of those divided by the number of shares out there that people own is the net asset value. So usually if you have it in your 401k or 403b or 457, depending on what kind of retirement account you got, that's when you get your monthly or quarterly statements, that's how they're going to value those shares that your payroll deductions are purchasing. There is a higher threshold to get into one of these if you are buying them on your own. Like, say, if you logged into Vanguard and say, "Oh, I want to open up an investment account," and so they'll say, "Okay, you got to put in a minimum investment of about $3,000 to open it up." Again, not a humongous amount, but definitely not a small amount either. Especially if you're younger, you may not have that sitting around. So it does provide a larger barrier to entry for some. Now, if you are enrolled in your company or employer's 403b or 401k plan, or even a Roth IRA plan, then sometimes you join in, and as long as you commit to regular payroll deductions, then this high threshold doesn't matter. They'll get you in there with just regular automatic payroll deductions. The fees are usually really low. Versus if you bought shares of a mutual fund that's managed by an actual human being, the expense fees are going to be higher. But for in any index fund, since it's just a computer program that is automatically buying shares of the fund, generally you're going to be looking at a fraction, maybe a tenth of a share or tenth of a percent of what your assets are. So it's super, super low. All right. So pros and cons for mutual funds, easy to understand. They're just meant to mimic the market that you were selected that you want to buy. It's hands off. It's great for long-term investing. Don't have to worry about trading commissions because the fund is not designed to trade shares in and out. They just open and close the shares as it is to match or mirror what the market is for those shares. All right, some cons. You have a little less flexibility. You can't really trade these. You actually have to surrender those shares and you got to fill out some paperwork, and it's administrative. You can't actively get in and out when you want. You can do it online, reallocate shares in and out. So, but it is a process. It may take 24 hours for it to process, or whatever long it takes to process. So it's not like trading where you see instantaneous changes in your account. Like I said, generally, if you're just starting it on your own outside an employer's account, it's a higher threshold. But if you're getting into an index fund or a mutual fund through your employer, generally shouldn't be a big deal. As long as you just promise to have it taken out of your paychecks, you're good to go. Now, let's go to the newer or the younger brother of the index fund, and that's called the ETFs. It stands for exchange traded funds. All of these track indexes just like the index funds do. But the biggest difference between an ETF and a mutual fund is it trades like a stock. You can buy one share, many shares, uh, and sell them on an app or a trading app like Robinhood anytime you want, even multiple times during the day. So you can't do that with an index fund in a mutual fund account. So you can't do it. So how does it work? The process is actually a lot easier. So you can just buy them and sell them on exchange through whatever app or platform you like to use, and all of them are available to you. So whether you like Thinkorswim or you like Webull or Robinhood, or I mean I use Tasty Trade, I have Schwab. I used both of those today. I actually used my Robinhood account today. I think I used my Webull account the day before, and bought ETFs on all four of those platforms. The price of the ETF shares change up and down just like a stock, depending on one, of course, supply and demand for the shares, but also two, how the underlying thing that that ETF is tracking is acting. So if an ETF like say GLD is an ETF that is uh, one of the ETFs that tracks gold. So if gold is up, then your ETF is probably going to be up. Uh, I've got an ETF that tracks something very specific, Palantir stock. So if Palantir stock is up, then my ETF will be up. Unlike the mutual funds, index funds, the hurdle is not as high to get in and out. You can just buy single shares if you want, depending on how inexpensive the shares are. Out of curiosity, what is GLD selling for right now? Shares. Of course, the new star is actually silver. Because I remember when I was a younger investor in school, I was interested in silver just because silver was low. Yeah, gold's not that cheap, but but that being said, an investment in GLD would have made you very, very happy. So again, this is just the last 12 months from 250 bucks to current price of 121. And again, part of this is a function of uh, geopolitical instability, maybe economic weakness. People always flock to where they perceive is safe. And instead of buying gold, where again, it can be lost, be stolen, you can do it digitally and just buy shares of an ETF of gold. And this isn't the only one. There are several different kinds. I think there is GDX. Again, this one of the cool things about ETFs, if there is a niche, there's probably an ETF for it. So this one is not gold necessarily, but this is like a index tracking all the companies that mine gold. So a gold miners ETF. Probably one of the more noted, let's see, metals on the planet is lithium, and Albemarle is probably one of the known miners. I got to trade in this one too. But here's silver. Silver has actually outpaced gold recently, which I did not expect. So the silver trust uh, is attractive for a lot of those that may not want to afford the higher price of the gold alternative. Nevertheless, very accessible. If you take a look at the chart for silver over the past year, amazing. You could have just 1 year ago, you could have got in when you saw the economic weakness. Said, "Oh, I might hedge my bets, play a little safe instead of investing in company, invest in silver." You would have been highly rewarded because take a look at that. It's almost tripled in price in just 1 year. So pretty amazing. I actually kind of did not expect silver to be big, but I think I can see it's a lesser expensive alternative to gold. So ETFs can be traded anytime during market hours, but these days, and there's been some recent regulations to open this up. There are now that exist because it's on Robinhood already, 24-hour markets. So even after the market closes, after the operations of 9:30 a.m. to 4 p.m., there is an after hours market now. So I've rarely done it, but every once in a while, if I think if price is an object and I'm more concerned about getting in on the shares, I'll get in on the aftermarket or 24-hour market, which is more volatile. But again, if you want to get into if time is not an object, nor is cost, and you desire convenience, you can get in on the 24-hour market, and ETFs gives you that big advantage over the index funds, mutual funds. You can't get in on those until the office or the is open on mutual funds. ETFs, you can get in and out of them depending on which letters you're tracking, ticker symbols. Certain ones are traded 24 hours, so you can get in on those. They're a niche that's out there. Just like I mentioned a minute ago, there's a cybersecurity ETF. There's a clean energy ETF. There's a crypto ETF. There's ones for single stocks, like I mentioned. Commodities, again, gold, silver, lithium. There's ones for what is it? Rare earth metals. Rare earth metals is something that a company or countries are now fighting for. And why is that? Rare earth metals are what power the materials for all of your smart devices. If you have a smart device, a smart microwave, smart TV, a smartphone, all of them require rare earth metals. And there's a reason why they're called rare earth metals. I think there's like 30 something of them. But if your country has them in the ground, other countries are going to want to buy it from you. So I bet there's probably a lot of rare earth metals in Greenland. You see Greenland on the news lately. So the largest, I think, proven reserves of rare earth metals, I think, is in China. So China has a leg up on the world when it comes to the materials to build some of the smartest chips in the world. So, which is why the United States, at least this administration, has been trying to prevent China from having the corner in the market of rare earth metals. So there are, again, niche sectors out there in ETFs. So you could trade ETFs based on what you hear on the news. Very specific stuff. There's ETFs for different countries. You could trade ETFs, again, on China, for example. Let me show you one on China. And I think I might remember the one for South Korea, too. Let's see. Yeah, here's the China Internet ETF. Okay, so this one's specifically internet companies. So, like I said, you can get in on some really specific niches. China Internet companies growth. So obviously, China's had a pretty decent run with their group of stocks. And again, this is an index of Chinese internet companies. And I think, is it? Yeah, here we go. Here's one, just South Korea. How's South Korea been doing? Must be a reason why I've traded this. Yeah. Whoa. All right. Yeah, this is the reason why I've been trading this one. So South Korea as an economy has been doing real well, as reflected by this index ETF. So again, shares $54, 111. Yeah, it's doubled in value. So again, you think globally. There's a stock with a negative EPS of 45.20. Vero. Oh, interesting. Negative ETF. Well, that means they lost money. That doesn't necessarily mean it's a bad thing. Take a look at Tesla. One of the reasons why I didn't buy Tesla stock for a while is because they never made any money. They operated at a loss. But just because they operate at a loss, especially if it's a new company, doesn't necessarily mean it may be bad. Just means that they are getting off the ground and it costs money to make money. One thing that it's hard to fake, are their revenues going up? All right. So this one, Hmm. So this is in penny stock range. Something exploded to cause their shares to go up. Either it's a meme stock or something. I can't tell because I haven't seen the stock. Generally, stocks less than $8 are off my radar. I call them, quote unquote, the penny stocks. Not that they're bad. It's just that they're not liquid. And the reason why, I and I learned this from one of the best traders I know in the world, um, Tom Sosnoff, is liquidity is the key here. Average volume, it's barely a million shares, 1.7 million. For some strange reason, volume is 254 million today. So the reason why you want high volume when you're trading is because you know you're going to get a fair price for the shares. You want to look at the spread. The difference between what people are willing to pay for a stock and what people are willing to ask for a stock should be pretty narrow. And that's called the spread. This is a very wide spread here. It's a $4 spread. Too wide. It's hard to know that you're getting a fair price because there's such a wide gap between what people are willing to pay for a stock and what people are willing to sell a stock. So thus, you see a lot of this volatility, and even with kind of relatively low volume. So this is like a micro cap stock. It's only worth $18 million. I don't know what they make, but I am curious about why it's up today. So very interesting. All right. So pros, as you can see, it's really easy to trade. You can use any application or platform to trade ETFs. Because there's a very low barrier to entry, it's great for small budgets. So tax efficient structure. Unlike mutual funds, which distribute the capital gains from buying and selling shares back to the owners of the shares, which is you, that potentially may lead to a higher tax liability come tax time with mutual funds. Unless they're in a tax sheltered account, then you don't have to worry about that. ETFs, they don't have that problem. ETFs also have a low turnover, meaning that they're not going in and buying shares of the companies in that index in and out every day because it's designed to buy all those shares unless the structure of the index itself changes. So generally less tax liability with ETFs. With index funds, you're going to have low tax liability anyway. They're not going to really buy and sell a lot of those shares as often. You're just going to have a better chance of lower tax liability with the ETFs. Unless, of course, you're short-term trading, and that's a different story. I'm not a tax guy, but that's kind of like the general explanation. Some cons: ETF prices can go up and down in a day, just like the stock will. You take a look at gold and silver. You take a look at individual company stocks or industries. If say one tech company reports bad earnings, then the entire index may go down for a tech stock ETF. Some ETFs may be complexly designed. There are things called inverse ETFs, which means they go in the opposite direction of the market. I have a couple of trades in that just because why not? Hedge your bets. SDS is an ETF designed to move in the opposite direction of the S&P 500. So it's an ultra short, meaning when the market goes down, which I assume the market is down, this goes up. So that way you can make money, and this is why you have to kind of be open and be able to pivot depending on what the market does. You can make money whether the market goes up, down, or sideways. A lot of people don't realize that. People just think of market goes up, that's good, market goes down, that's bad. Not necessarily. I think there's another one that I have here. I think it's two of them. Here's another ETF. For the QQQ, which is the NASDAQ 100, all the tech stocks. So if the tech stock goes down, tech stock market goes down, the NASDAQ 100, which is the 100 biggest tech stocks, then this goes up. So if the tech market is down, this goes up. Well, if this is going up, out of curiosity, what's the tech market doing? And this is an index fund representing the NASDAQ 100. I bet the NASDAQ's down. So it looks like it is. Yeah, NASDAQ's down. If we look at the market itself, just based on the homepage, let's see what the market's doing today. Here, yep, NASDAQ's down just slightly, less than a fraction of a percent. But again, that inverse ETF goes up. So sometimes it's nice to be able to have that flexibility in my portfolio to have stuff that moves in the opposite direction of the market. When COVID hit and everything was going on in the market, I was able to recover a lot of what I'd lost by going the inverse, betting the market would go down. So side by side, index funds, they trade once per day. ETFs, you can trade all day. Index funds are priced at the net asset value per share. ETFs, it's whatever they're selling for at the market. Pretty easy. Index funds usually have a minimum to invest with them. ETFs, usually none. Just open it up, pull up the ticker symbol in your Robinhood account or Tasty Trade account, and you're good to go. Fees in index fund generally pretty low because they don't have a human being needing to manage it. ETFs are real low because as long as you use a platform that doesn't charge you any commissions, which you shouldn't because that's pretty much the standard these days, they're very low. Tax efficiencies are good for index funds, are excellent for ETFs. Both are great for long term. You don't have to babysit the index funds and mutual funds. Really easy. Just stick it in your retirement account, or if you're young, stick it in a Roth IRA, you're good to go. Because that way, once you take the money out, you pay zero taxes on it. Not bad. I actually trade inside my Roth, and I don't have to pay any of the taxes on the gains. I don't have to pay the taxes on the dividends inside of a Roth. So Roth is my favorite vehicle, actually. ETFs, a lot of flexibility, a lot of different ways that you can mimic the market without having to learn about different companies. Basically, whenever you buy an ETF, you're buying a basket of companies or a particular strategy: gold, silver, industrial parts of the world. So also good for small budgets. So you got two options here we talked about today: index funds, mutual funds, and then we got the ETFs. Index funds are great if you're sticking in an employee retirement account, 401k, IRA. Fantastic. Set it, forget it. If you like simplicity, if you like to do it automatically, if you're long term, and you don't have time to babysit individual stocks, and a lot of folks don't. Got a best friend who he doesn't have time to do that, and nothing wrong with that. That's most people. If you don't care about trading, index funds the way to go. ETFs are good if you regularly invest, maybe trade for the long term or even the short term. Low threshold to try to get in on it if your budget's really not that big. ETFs give you a lot of flexibility because they can mimic whatever is in any of the index funds, but then just put it in a stock form. If you like to buy and sell during the day without having the restrictions of certain formalities of the mutual fund, then ETF is the way to go for you. Some misconceptions that, were these stocks? Not yet. When I emailed the recap, plus I emailed the link to the recording, I'm going to attach these. So great question. ETFs are riskier. Not true. It depends on what you're tracking. So obviously, you may have a high risk, high reward investing in a mutual fund or an ETF tracking the NASDAQ 100 versus the S&P 500, just because it's just by nature more volatile. It's the ETF itself not risky, just what you're investing inside the ETF is where the risk is. But again, generally, if you're investing in an index, it's going to be a whole bunch of companies. So they're not all going to move in the same direction, which is why the S&P 500 is kind of like the gold standard. You got 500 different companies, and they're not all going to move in the same direction. Index funds always have lower fees. Uh, Not all the time. ETFs can have equal or lower fees just as low as index funds do. You need a lot of money to invest. That is always a misconception. If if you got money to go out and get a $7 value meal or coffee at Starbucks every week, you have money to invest. Work with your review document. Okay, so if you're in the investment club email list, then I just email that out to everyone. If you're in my class, I'm going to make a note to myself just to post this in the announcements board, so that way, or the discussion board, like in the coffee shops, that way everybody can see it. And I'll let you guys know where to find it, because I think this is great for all of you, especially those of you that have never been in the investment club before. You need to pick the perfect fund. No, that's the nice part about index funds or ETFs that track an index, is that you don't have to be perfect. You just need to, you could buy everything, really. If there is an ETF that is the entire stock market, I mean, you can't get any more diversified than that. There is a total market ETF. If the S&P 500 isn't big enough for you, uh, you can go broader than that. So you can be pretty much diversified enough with just the S&P 500, the Nasdaq 100, and then maybe an international fund, and you're good to go. In reality, and I looked this up today for you guys, between 2015 to 2025, last 10-year, recent 10-year period, the S&P 500 beat about 90% of managed mutual funds anyway. So all those mutual funds out there that advertise we're the best, we beat the S&P 500, all these fund managers and stuff like that. Well, the majority of them can't even beat the S&P 500. So those of you that took my Fin 3400 class, I got a good story about Warren Buffett there for you, where he made a bet against hedge funds and won. So how do you get started? Again, I want to respect your times. We're about wrapping up the time. Open an account with any brokerage. I wrote just a few here. They're not all inclusive. There's plenty more, especially if you have an employee retirement account. So Fidelity, Schwab, Vanguard, big boys. Any investing app will work. Webull, Robinhood, Tasty Trade, Schwab, Vanguard. I've used all of those, and will use all those. Look for broad, low-cost funds. Again, you don't have to do my suggested S&P 500, but S&P 500, again, can't go wrong with that one. If your employer is offering choices, that should be at least one of the choices in your company's mutual fund. So again, don't just stick your cash in or stick your investments in your retirement account at work and just stick it in a money market fund or a high yield fund, because inflation's going to eat that alive. So if you stick in an S&P 500 index fund, again, this is reaching all the way back since 1927. It's averaged between 8-10% a year. So you're going to beat what you're getting in a money market every day, every year, because cash is going to be a drag on performance. I saw a study today about that, which I could talk about another time. Start small. The threshold is low to get into either of these. Even 20 to 50 bucks a month can build wealth over time, and especially if you're younger. Again, that's when I started, when I was still a kid in school, and it paid off. I still own the first stock I ever bought when I was still in class, and that's Microsoft. So, and haven't sold a single share since then. Although I will sell some shares eventually when I can enjoy them. If you put the same amount around the same time each period, that is something called dollar cost averaging. Those of you that ever been at one of my investing or finance workshops or personal finance, I talk about dollar cost averaging all the time. That's just putting the same amount around the same type period every period, whether it's every week, every about 2 weeks, or monthly. And what that is, it just takes luck and timing out of the situation. So if the market is up, great. Doing it that way means you buy less shares when they're expensive. If the market's down, fantastic. That means you're buying those same shares when they're cheap. As long as nothing has fundamentally changed why you want to buy those shares in the first place, dollar cost averaging is the way to go. And I do that with a couple of the big boys right now. Recently, I've been doing dollar cost averaging every first week of the month when I get my first paycheck. I'm just sticking $100 a month into Meta and Netflix right now. That may change if I see more compelling reasons. So, last few years before 2025, I had been doing it with Amazon and Alphabet. But I switched it to Meta and Netflix last February, because when I saw the writing on the wall that tariffs were coming, I go, well, at least in theory, I didn't think Meta and Netflix would be affected by tariffs as much as other companies like Amazon, for example. So, automated if possible. If you don't have to think about it, and it's automatically taken out of your paycheck and going right into your checking account, even easier. So, bottom line, to sum up, doesn't matter which one you pick, the key is starting. Again, ETFs are a little easier, but either one is great. I do both. So I buy my ETFs every week, actually. So I have specific ETFs I buy each week depending on how much they pay out in dividends. So I have a little calendar of that. But my paychecks go out into the S&P 500 index fund, and then a fraction into international. So it's a way to go. So stop it right here. Again, I want to respect your time. We always meet for an hour. And those of you on the email list, I'll go ahead and email you a link to the recording and the handout and the agenda. And those of you in my class, congratulations, you just earned extra credit. So when I watch the replay of the video, I'll see who showed up, and I'll make sure to put the extra credit for attending into your class. So thanks, everybody. Does anybody have any questions before we go? Yeah, we have questions here. Awesome. Let me answer these. Let's see. Can you explain how an option might lose or gain value using the delta? Yeah, I can. So, Kimberly's question. So, option could lose or gain value using delta. So, if the delta increases, for example, and again, I'm just talking pretty broadly without using an example. A delta basically gives the probability, this is one way to explain it, that the option is going to be in the money. So if the delta is like, let's see, you try to think of an example. So if a delta is, say, like 60% for a particular underlying stock option, then that means there's a 60% chance, because you can kind of liken probabilities to deltas. That means there's about a 60% probability that the option is going to be in the money. So, which means that you would, if you are like a seller of a put option, for example, then you would be obligated, if the stock goes into the money, to actually buy that stock. So, or if, for example, if you buy a call on an option, say if I buy a call option with a strike price of 100, and the stock right now is 110, then the delta could be kind of low. Could be maybe a 50 or 60. But let's say the stock goes to, let's see, what I say, strike price 100, and the stock is what, 100. Oh no, I should have said that the stock is at 90 and the strike price is at 100. So if the stock goes from 90 to, say, 101, then it's in the money on the call option. And then so the delta could definitely goes up to 100, because there's a 100% chance that you're going to be in the money because you already are. So I don't know if that helped out a little bit, but just off the top of my head. Oh, you're welcome, Bridget. I know I'll see you at the next meeting again. You're welcome, Ashley. Sabrina, oh, great. I'm glad you came for more than just the extra credit. Thanks, Sabrina. I try to make things a little accessible and easy, and that's why Investment Club is. This is not my class. This is a club that I really love, and to have been a faculty sponsor with for shoot. Now think about it. I'm going into over 5 years now, so I'm glad you enjoy it. That's why. And Moneymakers Club, by the way, is one of the biggest clubs on campus, and even though we may not have all the members come to the meetings, we have one of the largest email lists. People still love, and especially I have alumni still attend just because they like the information, which is great. How do you join the email list? Oh, James, great question. I tell you what, just so I don't forget, uh, go to the coffee shop board in your class and just post that, hey, I want to be added to the Moneymakers email list, and just put your preferred email list, whether it's a school email or regular email, and just let me know there. And as soon as I see it, then I'll add you to the email list. Caroline, could share documents with us? Yes, I'd be happy to. I'm gonna, since there's such a lot of requests for it, which I appreciate, I'm gonna go ahead and post this in Canvas for you guys. So yeah, I'm glad you find it helpful. Um, for those of you in the Moneymakers email, then the document's gonna be in the email. Will the not meet associates in class and on the email list? Yes. Great question, Ashley. Yes, I'm going to make it available in both the classes and in the email. Oh, you're welcome, Jesse. Uh, thanks. How can we add the club email list? Oh, fantastic. Love to have you in the club. Actually, because I used to go to all the club fairs and on campuses all the time, and I was one of the folks. And when I had officers that would sit at the table and recruit with me, like Harold, for example, who is uh, my class or club president, who is here in attendance tonight. So, but since I have to recruit virtually, yeah, I'd love to have you on the email list. Do the same thing if you could, Kimberly. Go to the coffee shop board for me in your class and write down that you just want to be added to the club email list with whatever preferred email you like, and then I'll make sure to add you on there. Let's see. All right, yeah, same, Jesse. Just go ahead and post your name on the coffee shop board, and I'll make sure to get you in there. All right, all right. We meeting once a week this term? That's a good question. I think. Oh, fantastic, Kimberly. I love hearing that. Thank you so much. Thanks for the kind words. Uh, Harold, great question. We met, well, when we were face to face, it was easy because we had both the evening meeting and the day meeting, so we could monitor the markets when we're open. Since I'm kind of on this international schedule, to make it a little easier on me, I don't know if I could do 1 week uh, or every week, but at least for January, I think I could do it bi-weekly just to make up for December. So I'm gonna kind of keep it to a month just to fit in my schedule. Yeah. Thanks again, Kim. Great questions. And again, I'm gonna go ahead and have this sent out to you guys. Uh, where is the coffee shop board? Oh, Alyssa, great. So if you're in my class, if you go to click on discussions in Canvas, the coffee shop board, which is the non-graded discussion board for a free-for-all for anything, which is why I made it, just click on discussions, coffee shop board is in there. All right. Any other questions out there? Great questions, by the way. Oh, one thing I did forget is, oh, thanks, Adelaide. Thank you. One thing I forgot to ask if there's any topics that folks wanted to recommend for next month, although I still have a list from previous month. Uh, all right. I appreciate everybody coming by. Options trading, that is honestly one of the most popular topics uh, in Moneymakers, actually. Usually every couple of months, that is one of the most requested topics. And I don't mind that topic because since I do that every day, uh, I have no problem reviewing that one. So let me make a note that that is a popular topic. and put a little asterisk on that. I have a little notebook where I keep track of all the suggested topics. So yeah, I could definitely fit that in for the next meeting. Thanks for reiterating that, Kimberly. All right. Well, oh, thanks, Bridget. I'll try to send some pictures when I can. We're just settling in here in Bangkok for now, but I look forward to sending you some more. All right. Well, let me stop recording here. But yeah.